now we have Josh Bresette, who's the president of Hudson Oak Partners, which is a dynamic blockchain and cryptocurrency consulting company with special emphasis on block trading and token liquidity, ICOs, and investment and financial capital. Can you please give Josh a very warm welcome to the stage?
Okay, so my presentation is going to be on token liquidity and block trading. Is there anybody in the audience who feels they have an understanding of token liquidity or block trading? No, okay. Well, I'm going to show you some slides and I'm going to bring it back to why token liquidity is critical to cryptocurrencies as well as to initial coin offerings, and for an initial coin offering to have a strategy around token liquidity. So token liquidity, from my point of view, has three attributes. It's the ability to buy or sell a token without affecting the token's price. It's the speed by which you can do a buy or sell order and execute it also without affecting the token's price. So what I mean by that is that if I'm doing a $5 million buy of a cryptocurrency, that if I do that purchase, I don't have to do it over 12 months to keep the token price relatively stable. The third attribute is the ease by which the token can be converted to fiat or fiat to the particular token. So a token is liquid if it can be bought or sold quickly without affecting its price, and the token can be quickly converted to fiat or vice versa. So just an example over here, this is a BitHorse token. So in theory, some people raised $30 million to purchase racehorses, that one of which they think will win the Triple Crown. Now, the token goes onto an exchange and it's being traded. The bids are 10 Bitcoin for the particular token, and the ask is 15 Bitcoin. So people are willing to buy the token at 10 Bitcoin, and people are willing to sell it at 15. So you have a huge 50% margin there where that token would be very illiquid. So what we try to do is try to bring liquidity to this market for a variety of reasons. If you want to look at trade volume by market cap, just so you can see how the liquidity changes quickly for the top tokens, yesterday Bitcoin did almost $9 billion in transactions. Ethereum did 2.7 billion. You go to the 20th token by market cap, it only did 113 million. You drop to the 48th token in market cap, Loopring, you did 48 million. You go to the 84th token in market cap, now you're down to 20 million. And now you're down to the 109th token, 10x, you're down to 2.6 million. Now there's 1,000, I believe, 739 tokens. So as you can see, token liquidity decreases quickly, which means small increases in volume as you go down can cause large price fluctuations. In addition, most, if not all, the tokens are tied to Ethereum or Bitcoin. So a conversion is needed. You have to take your fiat, buy Bitcoin or Ethereum, and then purchase the token. If you want to get out of that particular token, you have to do the same thing. So it's another attribute of being an attribute of low liquidity. So where we come in is block trading. Now, what is block trading in the cryptocurrency market? Well, block trading helps solve token liquidity. So it's a private contract negotiated between two parties. It's usually a significantly larger quantity of tokens. All the tokens are traded at a fixed price. So if I wanted to do a $5 million transaction of a particular token, if I'm doing it in a block trade, I can get all of those tokens at the same price. So I used an example down here of Dash. 3,500 Dash traded at $465. It's a $1,627,000, $500 transaction in US dollars. Now, if I went to an exchange in the open market, as soon as I start buying that token or selling that token, chances are I'm not going to be able to get it at the same price because the market's going to start moving based on the order book. The trade, again, is executed outside of the open public market or the electronic markets, and there's no large or immediate effect on the price of the token. So again, being able to do this outside of the markets and providing that level of liquidity increases the stability of particular tokens, but it also can attract institutional or other types of investors to those tokens as well. So these are the 61 tokens that my firm does large block trades for. So someone can go from fiat into those particular tokens, or they can go, if they wanted to sell those particular tokens and go to fiat. We help facilitate those types of transactions for these 61 coins. It creates a level of stability for those particular coins in this particular world. The reason I think that token liquidity is so important to initial coin offerings is because having a token liquidity strategy, again, is going to help attract more sophisticated investors. So investors don't like volatility. If you can come up with a strategy to manage volatility, then you're going to be able to attract a different level of investor to your particular initial coin offering. So we have firms that come to us that are looking at particular investments in cryptocurrency, and they're wanting to understand what we think the token will do in the market. So basically what that means is there's institutional investors out there who will look at particular investments, and with a token liquidity strategy would actually invest in those particular coins. So it's a market you don't hear a lot about, but it definitely plays an important role in the investment side of things. That was it. Thank you.